I think growth investors need to be a lot more discerning right now than they have in the past, largely around valuation. There are always pockets of opportunity in every market, and we're finding some companies that we're really excited about that we think offer a lot of attractive organic growth at good economics with a long runway, a good balance sheet, at good prices. But I can point to plenty that we'd struggle to wrap our heads around the valuation. So Zoom is a business that we absolutely adore. We use the product. It has great unit economics, inherently viral, founders deeply engaged. I have nothing critical about the business really to say. In fact, I actually think it's much more durable than most analysts think. But when you look at the price, it's hard for us to find a base case valuation where investors are going to get something like a double-digit return over several years. And I struggle to get excited to back something where we're not going to get that kind of profile. So even though we're very growth focused, we don't swing at every pitch. That said, if you look at to go to Facebook, it's growing at 31% Forex neutral terms, which is pretty remarkable, but only selling on 22 times forward estimates. For context, you look at Procter & Gamble, it's growing 3% and selling for 24 times forward earnings. And I think what's happened is you have a lot of really high growth names that are really, really expensive, but then you also have some almost like bond proxy like investments like P&G or utilities that have gotten really dearly priced themselves. And you can have situations like Facebook where I think there's a really wide range of opinions on the business quality. But that's a good thing, because when there's a wider range of opinions, there's more room for you to add value through analysis and having a different perspective. It's surprising how few of these companies have rigorous capital allocation frameworks. And I know that's not necessarily the most exciting thing to talk about, but the reality is a lot of people, CEOs, CFOs, they're all smart. You don't end up running a listed business without being a smart cookie. But there's a big difference between being smart and being a strong capital allocator, which is a role and a position that people aren't really thrust into until they're in that position. But what we'll find oftentimes is that companies don't really have a good handle on their incremental returns on invested capital. So, how much are you spending to acquire a customer? What's the lifetime value of that customer? What is the level at which you think you're adding value, and where's your threshold when you don't? When you make an acquisition, what kind of returns are you looking to get off that? We oftentimes find companies can be a little loose about their standards, and I think those are situations where they make splashy deals and everyone feels excited, but years later it ends up being disappointed, and it's because they put a lot of money behind growth, but it was low quality growth. We get excited about businesses that are really analytical about how they reinvest into the business, and they have clearly defined hurdles. And at the unit level, they know, look, this is how much we can pay to acquire a customer. If we're not doing better, we can only spend up to that level. And we need to hit the gas when we can, get above that, but if not, we're going to tap the brakes. That kind of rigor and discipline is actually surprisingly hard to find, and we do get excited when we find it.